Okay, welcome everybody. Oh no, misfire already. Turn that off. So thanks everybody for showing up. It's episode 86 of the Volatility Barometer podcast. Very much appreciate the support. See, there's a bunch of questions in the chat already. So of course we will do the live Q&A today. But today we are basically here to talk about the new spreadsheet download that I uploaded yesterday. So if you have checked out that video, I'll just show everybody what it looks like, because I have noticed that sometimes people don't actually connect the two. Maybe they don't actually go to my YouTube channel. So let me just show you what the video looks like. And I can actually just poll the audience really quickly as well. So it's this video. It's the most recent one. You can see it's going to have something to do with the spreadsheet. And you're going to want to watch this one. Going to want to download your spreadsheet so that you have all of this data. But we'll get into all that. But right away, I just want to poll everybody. So I'm going to pull up two thumbnails. I basically paid a couple of people. As you know, I'm trying to get somebody to do my YouTube thumbnails for me because I'm really terrible at it. So the one that I went with, and I want everybody to kind of just vote in the chat when you see these. So this was the first one. He kind of did some of this and then I fixed it up myself. This is the one that I ended up going with, but I'm doing an A/B testing, so please bear with me. What about this thumbnail instead? This one, to me, I don't know. This one looks almost like I'm a cartoon character of some kind, but give me basically A, which would be this one, or number one. This is more, I suppose, conservative. You know, I'm almost 50 years old. Maybe this is more my style. And then certainly this other one seems to be a little bit more YouTube style. So give me an A or a B or a 1 and a 2. This would be the second one. And I'm just not sure, but I'm going to do an A/B test, but that's what it's going to look like. You're going to see something to do with the Excel spreadsheet. And today we're going to talk about the spreadsheet. I'm going to open it up. I'm going to show you what it is, because this data is actually pretty difficult to compile yourself. And I've been doing this for, I guess I started doing this, 2010-ish, somewhere around there. So just basically every single day I've been updating my spreadsheet. This isn't my spreadsheet. This is basically an introductory one that we're going to do publicly. But over time, if you give me recommendations and you say, well, I'd like to see this data point included in the next update, you can definitely give those recommendations. If it's not proprietary information, if it's not specific to my strategies, then I'd be more than happy to help you out and share that data. So first thing that we want to do is we need to get everybody here hitting that like button for me to get the YouTube algorithm going. Make sure everybody knows I'm still here. I took a week off YouTube. That's, not a great thing. But yes, please give me a like. And if you have a question, of course, put it in the chat. We will get to all of those later. But let's go ahead and open the spreadsheet and start talking about this. So the first thing that I wanted to do is just kind of show everybody how you're going to actually get this spreadsheet. So what you are going to want to do, I'm going to do this in the different order. In the video, I showed the spreadsheet first and then showed people how to download it. But right now, essentially all you have to do is just go to my website, volatilitytradingstrategies.com, and subscribe. Now, I will say all subscriptions do get a free 2-week trial. So look, I have to do a little bit of marketing here for the business. Of course, there is part of it there. But I will also be perfectly honest and upfront and say, there is a way to get this for free, of course, if you happen to cancel after the 2 weeks. And I also just want to say that, and this is just across the board with VTS, just in general, if you happen to forget to cancel your free trial and you get charged, you just email me and say, look, I went over the date, I refund, no questions asked. So don't worry if you're going to, you have to remember the date and cancel your subscription. But I would appreciate people stick around and check out the courses, check out the strategies, and actually participate in VTS. But yes, spoiler alert, there is a way to get this entirely free. So let's go through what this spreadsheet is. Now, like I said, this is the first version we're going with, but I think this is plenty to get people going, because a lot of times people ask me for this specific data. I know the VIX futures is extremely popular. I get emails all the time for people asking for this data, because if you go to VIX Central, they do have the historical tab, but that's going to take many hours to go through every single day for the last 20 years and put this together. Plus, everything that I do, because I am a quant trader and I'm trying to build strategies and compare different things versus each other, everything I do is down to trading days. Now that might sound like nothing. Yeah, sure, all data is trading days. Well, it's actually not. A lot of data that you will find, VIX futures is a little bit easier to get trading days, but if you're trying to compile it from something like the SIBO data, yes, it is actually extremely tedious. And especially when you get into things like we're going to do later with the crypto and all that, with benchmarks going back a long way, it is kind of a nightmare. What you'll find is you'll download a data set. Just next time you do that, match up the dates. I promise you they're not going to match. You're going to have to go through every line and figure out which one's the trading days. They skipped a holiday or whatever it is. Some data includes weekends. Crypto does that, of course. Gold does that. Anything that is traded off futures, it's going to be a nightmare. So please, again, thumbs up for me for putting this together for you. But it is the VIX futures data that most people are going to be interested in. And of course, I did include the trading days. This is very important when it has to do with the roll yield, because like I always tell people, contango and backwardation is just the headline stuff that people talk about. You've probably heard it a lot. Well, if this second month future is above this month future, then that's a green light to go short volatility. Well, that's not accurate at all, because of course, contango by itself means nothing. These two futures could be significantly below the VIX index, and that would technically still be contango, but that is a headwind for the short vol trade, because the roll yield, which is the comparison of the futures to the spot VIX, that would be negative. So it means that if you're looking for a contango signal, that's not going to be accurate. And the second part about that is days to expiration. Contango rises substantially as you approach expiration, because this future is going to decay a little bit faster than this one, and it's going to widen out. And what you'll find is the closer you get to expiration, sometimes the gap between the actual contango level and what is the practical trading contango level is a massive gap. It can be 15% difference. So again, contango backwardation is nothing. What you're actually trying to do is calculate the roll yield, how much this one is above this one based on the days to expiration. So you've got all of that going, of course, from 2004 when VIX futures launched all the way to the present. So that's good. Everybody asked for that. This one, of course, because for me personally, the cash VIX term structure, this is something that I talk about an awful lot. I personally love this data. I use it for a lot of my strategies and a lot of my trading. The differences between the 9-day, the 30-day, the 3-month, 6-month, and 1-year VIX, because the VIX index is a 1 month. Everybody knows the VIX. It's the most famous product. It's the one everybody quotes. But a lot of people don't actually know that there are VIX products for different time frames. So that's what this is. And so you'll have that data. 1 month, 3 month, 6 month, of course, goes back far enough. And then the other ones, VIX 9-day, don't have that one. It starts in 2011. But personally, just a little heads up tip. And again, what I will say is this spreadsheet is kind of a work in progress, and we're going to be using that as a baseline to do some future testing and strategy building. And so I'll give you a little tips here where you can sort of navigate this data a little bit better. And the first one that I would say is you might want to entirely skip the VIX 9-day, because you can imagine that the shorter expiration that something is, the faster moving that product is going to be. So at the 9-day, this thing goes up and down a lot, and you're going to get a lot of false positive signals. So what I would say is you're probably more interested in comparing the 1 month to the 3 month, or even if you're a more long-term trader and you like slower moving indicators, then the 1 month to the 6 month. That's also a good comparison. But these three are where you're probably going to be focusing the most. I've included the VVIX. I personally, and I've been asked this a million times before, I think it's almost a useless indicator, but there it is. And then the Volley is very good, but it's not really the brand name. The Volley is essentially, you could think of it as the closest competitor to the VIX. The Volley is just measuring at the money premium, whereas the VIX is a strip of at the money, in the money, out of the money options. So they're very close together, but it doesn't get a whole lot of action. A lot of people don't know about it. But the Volley is a good indicator as well. So if you wanted to just use these interchangeably, the Volley or the VIX, you could do that. Now here, of course, the underlying indexes, because again, as we've talked about, and I've got multiple videos on the channel at this point talking about this point, maybe I could point to a couple of those. These latest three So you've got the volatility ETFs, VIX futures term structure, and this one here. I went over why supply and demand means nothing for the volatility products. And it's because they track underlying indexes. And so I've basically given you all the data for the underlying indexes for all of the products. So going across the board, let's go down to where those ones start. You know, short vol, this is for the SVIX. If you're an SVIX trader, if you're a UVIX trader, you'd use the long vol index. This is all basically the most common ones: VXX, UVXY, VIXY, SVXY. They're all using this one here. Of course, the old XIV was using this one. I don't think there's anything currently using it, but it's there anyway. SVXY. And then the midterm products are great as well. As everybody knows, I like those, especially the VXZ on the long side and the VIXM. But here as well, this is probably the second most common question that I get asked. So this data is, again, going to help a lot of people. We've got all the volatility ETFs going back to 2004. So now you can start running any strategies that you're testing, and you can go as far back as your metrics will allow. Now, I guess that's an important point to highlight here, is that just because you have the volatility ETFs going back to 2004, perhaps your strategy itself, the underlying metrics that you're using for your entries and exits, you may not have that going back to 2004, because we have to remember the volatility space is pretty young, right? These things haven't been around very long. I know it sounds 15 years, 20 years since VIX futures launched. Sounds like a long time, but in the grand scheme of things, that's actually a pretty short data set. So let's say, for example, if you were using something like the VIX to the VIX 6M ratio, you could do that back to 2004 because you would have that data. But if you're trying to use something, don't know why you would, but say the VVIX, for example, then of course you'd have to start when the VVIX data starts. But that's as far back as it will go for you. So super useful there. I think people are going to appreciate that. I threw in the old ones anyway because I've been compiling this for so long. I have it. The old XIV, the ZIV, and the TVIX, these are all gone. This is terminated. Both of these were delisted, but you've got that as well, just to play around with an old, XIV strategy, the OG of the short vol ETFs, basically. It was kind of a shame that Volpocalypse happened, but it did, and we lost that product. So this is probably where we will start our expanded testing. All right, like I said, the contango backwardation, this is not overly important, but for people who are new to this stuff, I just wanted to give you sort of a basic introduction to how some of these things are calculated and used. So I gave you the M1, M2 VIX futures, contango backwardation, a chart to go with it. Remember, this isn't overly instructive for your actual trading strategies, but it's there for you just to understand, essentially for some of you, just how basic formulas work, how to calculate contango, how to calculate, a list of percentiles. I have included all the very basic formulas. And that's another thing in this spreadsheet. I tried to keep things as basic as possible as far as Excel formulas go. There's nothing in here that's complicated. You can do all this yourself. And then you can just start the process of expanding yourself. I started doing all this stuff. For me personally, it was back, 2005, 2006, I started compiling data and running testing on it. And then when the volatility products started to launch, VXX and then UVX or XIV in 2010, that's when I shifted over to the volatility ETFs. But I've been doing this for so long, but I do actually remember starting out and doing basic stuff. And you start with a spreadsheet that has 4 pages on it. And then a year later, you've got a spreadsheet that has 50 pages on it. And, it's starting to slow down and you're starting to get the beach ball if you're using a Mac. So you have to get another spreadsheet and keep going. Hopefully for a few of you in the community, I know this isn't for everybody, but a few of you in the community, I think this will set you off on a path that you may be surprised where you end up in a few years. So anything I can do to help people sort of get on that process, that's what I'm here for. I know what I do. I know what my strategies are. They're obviously far more complex than the stuff you see here, but this will get you started. So you've got that data as well. And what I would say is if anybody's looking for a homework assignment, why don't you do a percentile chart of the actual roll yield, right? You could do something very, very simple, like the M1 VIX future roll yield to the VIX index. You don't have to actually calculate the VX30. You could actually just do an M1 to VIX roll yield, and that is somewhat instructive on what's going on. And then from there, you could expand it out, and you could do a VX30 roll yield, and keep going from there. And who knows where it's going to take you. So this is the VIX index. This is just a data set, but going back to 1986, interesting that it includes 1987 there. You can see how bad things got. It actually touched 172 intraday, if anybody is curious about that. The VIX can go over 100. For some reason, people think the VIX caps out at 100. It does not. It can go as high as volatility can go. And then again, percentiles, you can just kind of poke around at the formulas, and you can start creating these things yourself. So maybe a additional homework assignment, start doing other percentiles, comparing other indexes versus this. So VIX versus the VIX 3M ratio, for example. Do that and figure out if that data is helpful for you. As far as benchmarks go, I did want to include one. And in my opinion, even though this is extremely basic, essentially what this is the stock market total return index for the S&P, which includes dividends, going back to 1990. Trading days only, everything organized in trading days only, and that's the S&P. And then the total bond index, this is also very useful because as surprising as it is, bond is actually a very important part of the investing world. I know lately in the last couple years, bonds have been a nightmare, and people are asking, well, why would anybody even hold these anymore? That is very short-term thinking. That's recency bias. Obviously, in the last 2 years, they've been decimated, but that's probably not always going to be the case. Remember, the bond market is significantly larger than the stock market. So this is actually quite important data, even though I know some people are probably rolling their eyes. What kind of boomer holds bonds anymore? Well, maybe they'll make a comeback at some point, who knows? And then I've got spot gold, again, trading days only. This is somewhat important because, as I was going to say, this combination of a 50-30-20 stocks, bonds, gold, this is actually probably better than, say, 90 to 95% of the entire investing world. Probably 95% or more, to be perfectly honest. And all of the asset managers out there that have their own style of portfolio, like the Ray Dalio all-weather portfolio, whatever it is, those are going to be significantly worse than just a dirt simple 50-30-20. So whatever you've heard, the cool names, the dragon portfolio, the cockroach portfolio, whatever they call them, you can bet almost guaranteed it's worse than this on its own. So if you can build strategies that beat this on both an absolute basis long-term and a risk-adjusted basis long-term, you're probably doing very good, and you're probably in the top roughly 5% of investors worldwide. Imagine that, making, if you could make 8% a year for the next 20 years with a drawdown that's only 23%, that is actually considered extremely good, surprisingly. A lot of people think, well, no, there's this guy on Twitter that makes 50% a year. Well, okay. Don't let me go off on another rant so early in a live stream, but no, they don't. That's just Twitter traders. They there's no track record and there never will be. All right, this is one that I wanted to just highlight here. This is the Bitcoin data. Again, trading days only. Not so easy to compile this, but simple enough. It's Bitcoin. But what I wanted to tease everybody is, as many of you know, we've been talking about it for a couple of years now, that I've been testing my Bitcoin strategies behind the scenes, doing everything that I've always done with my options trading, my volatility trading. I've been testing and just crunching numbers and coming up with all different ways to trade these things. And I'm basically at a point where I think that, for me personally, I've been trading it with live money for a couple of years, doing my testing, but I'm getting very close to being able to introduce something. So I did want to include that Bitcoin data just so we can get to the point where I believe trading Bitcoin tactically, which would mean rotating in and out based on whether it's a good time or a bad time to be holding it, right? Not just, close your eyes and blindly hold something. That's never going to work for any asset no matter what. That just doesn't work because the drawdowns are insane and nobody can watch their net worth go down that far and not panic and do silly things, right? So I believe tactical investing, where you're mostly in during more the advantageous times, and then you're willing to step out and go onto the sidelines into safety, long term, this is a way to radically improve your risk-adjusted return. So I'm actually getting pretty close to doing that. So I wanted to give that data to the community so everybody else can start crunching their numbers as well. I think Bitcoin is something that, I've talked about this a lot in, say, the last year specifically. I'm getting asked all the time. Bitcoin is something that, and this might be an unpopular opinion, so don't kill me in the comment section if you disagree, but I think Bitcoin is something that is slowly going to die, right? As the world moves towards central bank digital currencies, the powers that be are obviously not going to allow, if at all possible, and that's a side argument in itself, but they're not going to allow competitors to their own currencies and their own methods of paying taxes and things like this and reporting actual incomes. And they're just not going to allow that to happen. They're going to do everything they can to stop that from happening. So I believe Bitcoin's days are numbered. And when I say that, I don't mean next week or next month. I think that over time, it's probably going to continue to grow for a couple years. I think the Bitcoin, the cryptocurrency market, it still has a few years where it could see explosive growth on the upside. I'm not saying that it's dying and it's going to fade from, 65 or 70,000 down. I think it could go on another incredible bull market run, maybe a couple. But you have to understand that the whole narrative around Bitcoin, at the very beginning of it, don't lose sight of the fact that it was because the governments are so draconian and overreaching and there's so much regulation and they're trying to interfere with your choices in your life. And that's the whole reason Bitcoin's here. So why people would think that that's suddenly solved and it's never going to come back again, that I don't understand. That on the one hand, the government's the most terrible thing in the world, and we need to figure out a way to not use their money anymore. And they're so overarching and so powerful, and and then on the other hand, they can't do anything. That seems to be a terrible assumption on my part. So I think that the government can do an awful lot to stifle Bitcoin. Basically, they could just outlaw it, right? Just make it illegal. And that by itself is going to stop 90% of the people. That won't stop your favorite YouTuber from talking about Bitcoin. That won't stop the diehard Bitcoin loyals that have been doing this for 10 years. Government saying, can't use it anymore. You have to use the Fed's digital currency whenever that is released, the central bank digital currency. 10% of them are just going to say, no, we're going to be outlaws and we're going to just do this best we can. But we know that 90% of the population is just going to be like, well, yeah, I'm not going to willingly break the law. I'm not going to willingly go against the tax code and all these things. So you have to remember that just making it illegal is probably going to kill a massive portion of the volume just right away. And we saw during the pandemic, hopefully I can say these words at this point, enough time has passed, but during the COVID pandemic, most people just comply, and that's what's going to happen next time around. So I think the best way to trade Bitcoin going forward will be to have tactical strategies where you're willing to see the signs and sit on the sidelines and wait it out, wait those down periods out. So that's what I'll be doing, and you've got some data now. You can start running some numbers on your own stuff. I think it'll be very interesting. I think that as more and more time goes by, the concept of buy and hold and just doing nothing will increasingly become obvious that that's a bad strategy, right? You can see on the charts, if you were a Bitcoin holder for all this time, you might think, wow, obviously buy and hold is the best way to do this. It's made over 100% return, and all I have to do is hang on to it and I'll double my money every year. But what I think you're not factoring in is that the volume on crypto didn't really start increasing until about here. I think you can basically just ignore all of this. I think it's safe to assume that everybody watching this live stream, nobody bought Bitcoin at $2. So I don't think that's relevant in our world. If you did, congratulations. I don't know why you're watching my live stream right now. You've probably got a $100 million yacht somewhere. You should go on that and you should just live your life on your yacht. But for the vast majority of the rest of people who are interested in crypto, this is far less impressive. And this does require tactical investing. To be honest, and I'll show this in future videos, Bitcoin isn't a whole lot better than leveraged equities. It really isn't. Now, if you go all the way back to 2012, yes, it's going to beat it on every metric possible because it's up 115% CAGR, right? That's insane. But if you start at a reasonable volume level in 2017, it's actually fairly highly correlated to equities and not any better on a risk-adjusted basis. So, spoiler alert there, teaser. There is videos coming talking about this. But go ahead and use your Bitcoin data And like I said, having trading days only instead of including weekends, it means that you can just build this and just compare it straight up across the board to anything else you're doing. And if you want, you can just compare it straight up against our VTS strategies, right? That's the whole point of tactical investing, is to find the best portfolio. And in order to do that, you need uniform data across the board. So there you go. I'm very interested to see what people come up with. Of course, you can leave your comments. Quick note, there's inflation as well, but everybody knows what inflation is. I would just say, don't forget to inflation adjust all your strategies. Do all your testing based on that, right? I've got a video coming up soon, probably in about 3 weeks, that I'll be talking about why the inflation rate is significantly overstated and, or understated, I should say, and actually super important. So there you go. There's your spreadsheet. Let's talk about how, hold on. No, seem to be out of focus for some reason. Does that bother people's eyes? Let me see if I can reset my camera. Is that working? I seem to be fuzzy. Is that me just because it's late at night and I'm tired? Anyway, let me show you how to actually get this spreadsheet yourself. So hopefully the screen share here is clear enough. So again, like I said, what you're going to do is go here, and then when you sign up, you will get a series of emails from me introducing the VTS community. And among those emails, you're going to get one that looks like this. So essentially, it's just going to be the day 13. You can skip straight to it if you want. Like I said, I would appreciate people give my work a look. I've been doing this for so many years. I've added a lot of value to the community. Hopefully people can actually show a little support and give it a serious shot. But again, like I said, it's not going to hurt my feelings if you just accelerate to day 13. It's over here. You can see a download link and, you know, super simple instructions. This could not be more simple. You just download the spreadsheet and watch the video. The video is right here. It will explain everything. So just click the button. It's going to download your spreadsheet. I just downloaded another copy there and you're good to go. Now, as far as updates, I am going to be updating the spreadsheets. God, that bothers me that I'm out of focus. All this expensive camera gear, and look at me. I wonder what happened. Anyway, it's because it's on autofocus and Sony is supposed to be better. Apologies. You're going to have to look at me fuzzy here unless I get up and go actually turn the camera off. But I'm going to be updating this quarterly. So every, March, June, September, December. And I'll not only update that data, but I will be checking everybody's comments. So every time I make a YouTube video, make sure you make a comment. Oh, it'd be great if you could include, Ethereum prices, or it'd be awesome if you could include something, volatility related. I'd be more than happy to do that. Like I said, if it's not proprietary, no problem. And I'll be adding pages to that sheet as well. And then I will also be doing specific videos. I am actually planning to make this a course. Right, so we've got a course library at VTS, and there's several courses already there. So when you sign up, of course, you can learn all about this stuff. Tactical investing, this is, volatility ETFs, iron condors, we've got stock replacement. Volatility trend is UVXY butterflies. What else is, some of these are on the back end, right? So some of these are not public. This one's live, these both live. Volatility ETF landscape, volatility dashboard. Risk-adjusted return is coming. It's not live yet. What else have we got? Total portfolios live. You get the point. But this one here, essentially, that's interesting. It's the last one. But the Volatility Data Spreadsheet course, I am planning to introduce more lessons where it is based on the spreadsheet. So I would pull out the spreadsheet. I'd say, hey, we're doing a test here. And I would actually run the video through the spreadsheet, and then I will update that page and give it to your next update. So your spreadsheet will actually eventually start looking more like mine do. It'll be a nightmare. It'll crash your computer. Hopefully, if I'm doing my job and you're doing your job, testing everything, then it won't be long before your spreadsheets crash your computer as well. And you'll notice you'll feel my pain when I say that. You know, I can't stand my spreadsheets, especially live on the fly when I'm trying to answer questions. I have essentially 8 spreadsheets now, and I know where the data is in that spreadsheet. So somebody asks a live question, I think I've got it. That's spreadsheet 4. I can go right to it, and then it'll beach ball for 5 minutes, and I can't do it. So very, very frustrating stuff. Wonder if this is going to work. God, come on, Sony. My shoes aren't that interesting. Is it fixing? Sorry, guys. I really can't fix this on the fly. Oh, well. Okay. It's a fuzzy live stream today. So I'm going to get to the questions in a couple of minutes, but I did actually want to just ask for some feedback from everybody. So I am 2 days away from taking my wife and my mom, so the 3 of us. We are going to Europe for about 5 weeks, and we're leaving Thursday. So this will be a good day to get your questions answered. I'm going to take my whole YouTube studio with me, and hopefully I can find hotels, and we're doing a cruise for some of that, so hopefully I can find some time to do some live streams. But that will all be internet related. Maybe I'll have to sit outside in a coffee shop or something. I don't know. I'll try to do some live streams. But my point is that I've never been to these places. So if anybody wants to email me that you've been there and there was a really cool thing that you did, or a restaurant you have to go to, or a tourist site or tourist attraction that don't miss this in that city, I just wanted to tell everybody super quickly the itinerary. And then I know we've got many Europeans in the VTS community. Maybe you can just give us a little heads up on what we should be doing, because, you know, we have not been here. So we're starting our trip. We're going to Amsterdam for a little bit, and I'm really looking forward to that. I've wanted to go there forever. So hit me up with suggestions on what we should do when we're in Amsterdam. And then we're getting on a cruise ship. We have to go from Amsterdam to Rotterdam, and then we're going to get on a cruise ship, and it's a Norway cruise. And that one is 21 days. So this is the cruise that we're doing. So we're going to be on the cruise ship for 21 days. And I think we're basically hitting every somewhat major city / town in Norway. And this is a good cruise because we actually get quite a bit of time. Some of the cruise ships you get 3 hours, 2 hours sometimes on land, but these are, you basically get the whole day. So, you know, Ailsund, Trondheim, we've got all these places. But essentially what I want recommendations on are the best places to go kayaking. So if you've ever been kayaking in Norway in the fjords or anything, which city should we just be on the extra lookout for doing that? And then we're also going to Scotland. This will be really cool because that's a part of the world that I'm quite interested in. I might actually just go there and live there for a couple of months as well. Just so interested in it. But yeah, as far as our Norway cruise, our 3-week Norway cruise, essentially I need recommendations on the best kayaking spot. I know that that's kind of the thing to do, or biking, you know, long bike trips. If you've ever done it, and I know several probably have, give me some recommendations. And then after that, what do? We get off the boat. We're going to go to Belgium. That's going to be our, set up a base there for a little while. We're going to go to, Brussels and Antwerp, Bruges. Love that movie, In Bruges. So we have to see if that clock tower is real, first of all. And then if it is, we're going to go up to there and check that out. And then after that, France, Paris for quite a bit. So that'll be interesting. It'll be my first Michelin 3-star, taking the wife to Paris is awfully dangerous. There's gonna be some restaurants that staggeringly expensive. I'm pretty simple. I just say, where do you want to go? And I just tag along. But yeah, if you know anything in Paris that we should be doing specifically, we're doing the Louvre, of course. We'll do the Eiffel Tower, touristy stuff. And yeah, if there's anything we're missing in those cities or anything in the region, like if we're in Belgium, hey, you should go to whatever it is, the country next to it, go to this place in Germany. It's just a short train trip, whatever it is. Give me some suggestions. basically enhance our trip. We've got almost 5 weeks, so should be good. I'm working the whole time. If I didn't say anything, people probably wouldn't know. I've been busy making videos and preparing blog articles, and of course I'm going to be working all day in all of these places anyway, so a lot of late nights on the cruise ship just by myself doing my work, but I always manage it. I'm pretty good at traveling with them and balancing giving them an awesome vacation and also doing my regular workload. So all you Europeans, I would very much appreciate some suggestions. All right, let's get into some of these questions. Again, sorry about fuzzy camera. Sony let me down. It's weird. This is the 86th live stream. Same camera, same setup. This has never happened. I wonder if it's this. Is it this? Could we go down a little bit? What are we doing here? Come on. You can find me, right? It can't. I don't know what it's picking up. It's something here. Stop it. That really bothers me. I'm kind of a perfectionist, as you know. This is rattling me. It's throwing me off my game. All right, focus. So here we go. Even if your strategies will tell when to move to safety position, wouldn't it be useful to add stop loss orders to positions? So good question. I like this question. So I suppose what you're asking, and I could just use a basic example from our email. Let's say, there we go, good enough. Let's use the defensive rotation here. Essentially what you're saying is, because most of the time we are in the QLD, at least about 65% of the time, we are in the 2 times NASDAQ, shouldn't we use daily stop losses just in case? Is that what you're asking? Is that your question? Yeah, and probably just leave the orders open, I would assume is what you're saying. So you just get into the trade and just leave the stop open. So there's a couple problems with this. The first one that comes to mind is that intraday pricing is extremely unpredictable. So let's imagine that something happened in the market. It's a really ugly day and it opens down. The Qs are down 3-4%, which would mean the leveraged QLD, which we use, it'll be down 7 or 8. This is obviously going to be an uncomfortable day, and it happens. It does happen. We are using 2 times leveraged NASDAQ in one of our strategies. So drawdowns, we've done tremendously good controlling the drawdowns, but you know, anything on a single day can happen. And even over a couple of days, you can wind up in a pretty significant drawdown. So I get what you're saying, but the problem is that when you get those big market moves, there's nothing saying that it won't recover later in the day, right? It is kind of just a crapshoot what you get. Sometimes the market sees that happening and everybody starts to think, oh, here we go. We're building to something terrible here and we're going to sell. But just as often as not, people are going to look at that and say, the market's, overreacting, and it recovers towards the end of the day and everything's fine. And then you're the one that exited at the bottom and took that loss. So I would prefer to just check the signals once per day and just use that. And if what happened that day is truly something to worry about, then surely the signal the next day would be to move to safety. And I've always managed my portfolio on basically 1-day timeframes. I take 1 trade per day. I enter my data about an hour after the market opens and we take the trade, and that's the trade for the day. I don't rotate in and out several times if the market's doing this, right? It's down, so we're out. And then 2 hours later, it recovered. Okay, now send an email, we're back in. And then late in the day, it started to crash again. Well, now we're out again. We don't do this. It's just 1 trade per day. The other problem is, if you look in historical data, some of the very best days in the stock market are immediately following some of the worst days. They tend to cluster together. So, and it works both sides of that. Some of the best days are right next to some of the worst days. So if you're in the habit of stop lossing out, you have exited a trade, and then the very next day it might be, let's say it's down 7%, and you thought, well, that's my trigger, I'm out. The next day it's up 6%. It's basically unchanged, and you look at that and think, well, I've locked in my loss. So again, if it's something to worry about, our signal will pick it up the next day. If it's not something to worry about, or the next day the market bounces, which very often happens, you don't feel like an idiot for being the person that exited, and then the very next day you would have just been whole again if you just held on to the position, right? And then the last thing, of course, you always have to be concerned about is stop losses don't always trigger effectively, right? Especially in a fast-moving market, you're talking about a day where you're worried about a big crash, something, the bottom falling out. there is absolutely no guarantee that those stop losses are even going to trigger correctly. You've got widening bid-ask spreads, you've got liquidity problems, you've got, all kinds of things can happen, and you can get some pretty disappointing fill prices. So I would say these are things that I've tested thoroughly, not just once or twice, but multiple times for many, many years. And I go back and I test it again every few years, and I try to find the best system for my portfolio. And I've never found anything that's close to as consistent as one-day timeframes. I'm not a buy and hold guy, as you know. You've got to be nimble enough to move out of positions in one single day, because 2 days, 3 days, terrible things can happen in 3 days. One day, yes, you can get hit, but the next day the signals will pick up and we will exit to safety. And you will take that hit, but at least it's just a one-day hit. And then on intraday, that's not helpful either. So buy and hold, not helpful. Intraday, multiple trades per day, bouncing in and out every time the market's doing this, that's completely stupid as well. You're going to get tons of false positive signals. You're just going to be getting whipsawed all over the place. So the most ideal time frame, in my opinion, is 1 day, right? Even though sometimes we will hold these positions for, we held this position, the QLD, from November 1st all the way basically to mid-April, I believe, like 5-6 months, we didn't exit. So I'm not saying that we exit and enter every day. If the signal is to maintain, then we just maintain. But I check these signals every single day to make sure that this is still today the best position to be in. And if it's not, we move to safety. If it is, we just hang in there. But 1 day time frames is by far the best time frame, in my opinion. Okay, next question. How max drawdown is calculated in your sheets? So it's done for you. Like I said, I tried to keep things as basic as I possibly could, because I understand a lot of people don't work with spreadsheets, and I am very far from an expert. I will also say that I just make it work, right? I've never really expanded on my Excel skills or anything. I only know what I need to know. And if I'm ever doing a strategy or testing something and I don't know how to do something in Excel, I'll just watch a quick tutorial, or I'll, figure it out myself, and then I'll learn that new skill. But I don't have this big overarching Excel skill set here. So I also like to keep things simple, but for this spreadsheet, I kept things extra simple. I didn't draw the data from one page to the other. Like if this was my own spreadsheet, I would have a master data page, and then maybe you'd have the VIX futures. You would just have it auto update for yourself. I thought that that's kind of a recipe for disaster. If something happens, it's going to mess up people's spreadsheet. So I literally have as few formulas as possible. One of them is the drawdown formula, and this is a very basic max drawdown formula. It is there if you want to see it, but essentially it's just checking the high level and then checking here. These look like positive numbers, right? But remember, a drawdown is just a percentage. So it's down 6%. Why? Because 93.76 is 6.24% below $10,000. And this works all the way down. So this is a new number, right? You can see it's 0. It resets here. So this is now starting to be a drawdown. And then boom, it's now at all-time highs again. Drawdowns, all-time highs. And this rotates, right? Now it's in a massive drawdown, right? This is buy and hold S&P 500, max drawdown 55. But you've got the formula here, right? It's, like I said, I tried to keep it as simple as I possibly could. You can probably, if you want to, if you're not planning to use my spreadsheet, you can take that one and start actually auto-populating some data if you'd like. You're introducing, A, it could slow your spreadsheet down, but B, if there's a problem, it can actually cause some issues. If there's one piece of data that's missing, sometimes the data feed itself has problems. So, but it's there for you. All right. Wow. This is, Reed has multiple questions. So let me go through this quickly. If you do want stops, evaluate if you want to do a mental stop based on QQQ. Setting stops on a leveraged ETF. Hold on. My camera's okay, I shouldn't move, right? But I just noticed my camera's cleared up now. I wonder why. Anyway, I think you're answering Nicholas's question. Could get you wide. Let's keep going. QLD and the like hurt less from some one-day move. It is the accumulation of several days that can beat up leveraged ETFs. I agree with that even though, I mean, at some point, we're going to get hit with something terrible. So this is something that people bring up sometimes, and it is just a reality of investing. You have to be invested if you want to make money. You have to risk something to make something, right? There is no free lunch here. Investing involves risk. So we're sitting in the QLD, and right now, with volatility where it is, there's no reason in the world why we wouldn't be net long equities right now. It is a completely stable, calm market and has been for quite a while. There's no reason at all we wouldn't be short vol and long equities. But that doesn't mean that we couldn't wake up tomorrow to a terrible day. Sometimes you get blindsided, but most of the time, there's a little bit of a lead in and volatility will elevate. Sometimes you'll get a couple of bad days and our signals will pick up very quickly and we'll exit. But there is always the risk of a one-day shock move. It just is what it is. We have to combat that by having a portfolio that's not entirely skewed to the market. We also have strategies that are net neutral, also inverse correlated. It comes with the territory. Again, going to my portfolio, some people ask, well, if the Iron Condor strategy, and this is just factually true, it has a lower rate of return than these two, right? Tactical volatility has made over 30% a year since we launched in 2012. Same with defensive rotation. These three strategies are all significantly worse as far as rate of return goes. So, I mean, you can imagine how many times I get emailed with people during a good bull market, and they ask me, well, why don't you just put all your money in these ones? I mean, clearly they're better, right? These are just, I don't mean to be rude or anything, but these are just questions from people who have no experience investing for the long term when you feel in real time a drawdown, right? It's easy to look at a chart and say, oh, I totally would have held on. I mean, that's completely fine. I would have just buy and hold, and it's obviously better. People run into this problem too when they're comparing the S&P 500 versus a trading strategy. I get this comparison as well. People will be like, well, over this 5-year period, you underperformed the S&P 500, right? Well, the S&P 500 in the last 5 years had a 35.5% drawdown during the pandemic, had a 28% drawdown during 2022. It had a 22% drawdown during 2020. These are drawdowns that people will pull the plug, right? My drawdowns have all been significantly less than that, and I get people who criticize my performance who left my portfolio because of a drawdown. So picture the logic here. My portfolio draws down, say, 20%. The person panic sells and pulls the plug. And then they come back and say, how come you didn't beat the S&P 500? And I'll come and say, well, hold on. You said a 20% drawdown was too much for you because you quit the strategy. But the S&P was down 35. You say you want that? You would have quit that too. You just weren't in it, right? So this is all hindsight thinking. The bottom line is, people massively overestimate their own risk tolerance. You can't watch your net worth go down that far and just stay the course. It's just, I know people look at a long-term chart and they see A to B and they skip over all that middle stuff and they think, oh, it's buy and hold, I would have been fine, I would have held on, and look at that return. Well, no, we know that 99%-ish of investors, they can't sustain the drawdowns of a pure stock portfolio. They just can't. And so I do the best I can, my whole side tangent here, but what I was saying is defensive rotation has made 33% a year since we launched, but it also had a 40% drawdown, 40.22, I think, during 2022. Tactical volatility. Why don't I put all my money in tactical volatility? Because it's made, 35% for the last 13 years, because it had a drawdown that was in the 30s%. And for me personally, that's too much. So I do include a diversified portfolio. Like I said in the beginning with your spreadsheet, the real goal here, let me go to the top. Why was I scrolling? The real goal is to beat this on both an absolute and risk-adjusted return. That's the goal. But it doesn't mean it's every year. It just means that long term. And in order to do that, of course, you have to include some strategies that are, going a little bit counter trend. So let me try to gather my thoughts here and get back to what you were saying. But essentially, I agree with you with this point you were making, that it is the accumulation of bad days. It's what happens over a week or 2 weeks. That's what kills people. This is why I said buy and hold is a complete non-starter, because if you're in the habit of doing that, yeah, I can easily sidestep something like the COVID pandemic, for example. We were in cash. We didn't have a drawdown then. Q4 2018, we didn't have a drawdown then. But it's not one day. It's, you know, you wake up 3 weeks later and you're like, damn, I should have sold out then. I mean, the backwardation, VIX futures went negative. The signs were all there. Why didn't I exit 3 weeks ago? That's what's going to hurt someone's portfolio. As far as single day crushing hits, there's nothing an investor can do to combat that. The only thing you can do to avoid the potential for a single day disaster move is to not invest, right? Everything else is on the table. If your money's in the market, your money is at risk. That is the whole game here. So unfortunately, and I totally get what you're saying about the stop losses, and I appreciate Reed, you know, going through this and answering your question, but it's just not helpful to try to manage your entire portfolio to combat something that we have no control over. As I always say, control your controllables. That's all we can do in the market. We are all risking our capital every day that we go to sleep. We wake up the next morning, we are all subject to what the market is going to do. Fortunately, we can do a lot of clever things to make the risk as low as possible. And that's what I do. So it's going to sound cold and callous, like I don't care, but I really don't focus on what if I wake up tomorrow and it's a big down day. There's nothing I can do about that. Volatility is 44% right now. Of course I'm going to be short vol today. I don't know what's going to happen tomorrow. So I don't worry about that. Not to sound cold and callous, it's a gut kick. If and when that day comes, fortunately, I've never really had massive single day hits because I've always picked up on the signals early, and I'm always very quick to cycle out into safety. But I'm not stupid. I'm going to be doing this for the next 25 years. At some point, I'm going to wake up to a day that's just, you know, it's just a miserable day, and it's going to take you 6 months to dig out of that hole. That day is coming, not only for me, but for everybody. So I wouldn't worry about your portfolio of single days. I would worry about day 2, day 3. What are you going to do then to mitigate the damage? That's how you actually win long term. All right, let's see. A, definitely A. Everybody thinks A. So I don't look good as a cartoon character, apparently. Number 2 looks like all the other hacks on YouTube. I agree. When I first saw it, I thought, there you go. But this is the same. I hired a guy and it was expensive, right? Expensive thumbnail. I hired the guy and he's done thumbnails for a lot of the big YouTubers. So I thought, well, you know, does a 50-year-old man actually need to look like a whole blasted out contrasty cartoon character, or should I just be reasonably professional? I think you guys are helping me here. A, point taken. Not a single person said the B. So, here we go. William, appreciate it. I'm providing tremendous value. You will not want to cancel, and you will not regret it. I appreciate the vote of confidence there. Like I said, I'm always straight up front. Tell it like it is. If you want the spreadsheet for free, there's a very quick and easy way to do that. And it's not going to hurt my feelings. You can still come to the live streams. But I would appreciate people realize that this has been, you know, 12 years live, 12 and a half years live with VTS, and 18 years of my investing career. A lot goes into this, and there's a whole lot more than just a spreadsheet. So check out the courses, hang out for a couple of months and do the trade signals. You might surprise yourself, right? I mean, unfortunately, we are all subject to the randomness of the market, right? And this is one of the things that kind of, you'll only know this if you manage a portfolio for other people, but I get new subscribers every single day, right? And so it depends on when somebody signs up and kind of luck of the draw, right? If somebody signs up and I get a really good run of performance, they think I'm a genius and they're going to be recommending my work and thinking, oh, this guy, it's unbelievable, his portfolio, you got to sign up. But I also get people who sign up when the very next week is the start of a downturn that we're going to be in a drawdown for 6 months, and they're going to think, well, this guy's a fraud. He's a con artist. Look at this. He's advertising these results, and as soon as I join, it's down. Yeah, it's welcome to investing. I wish there was a way for me to guarantee a positive experience, but you just can't. You know, I still to this day, it's what, May 2024, June 2024, I still think about the people that joined in 2022, because that's the only negative year that I've had. It was a poor year, right? And I feel bad. I still to this day, we've recovered it all. We're off to all-time highs. Everything's kind of fixed and nothing went wrong, but I still feel guilty for all those people that they looked at what I was doing and they signed up just at the absolute wrong time, you know. 2022, that's going to be, it still haunts me. But yeah, give VTS a shot, take the free trial, see if you like it. All right. Oh, you got 3 here. Why do you say that buying VXX does not increase its price? If people would buy the VXX and let's say 1 billion, the ETF would buy a lot of VIX futures. This would increase the VIX futures prices because there are not enough sellers at the current price. Supply and demand has driven prices, the future risks. Just like with the election where many people buy the corresponding VIX future. So you're right if it's an extreme enough amount of money. So I guess going forward, if I wanted to preface it by saying, look, if we're talking about billions of dollars going into the same thing on a single day, that's essentially what happened during the Volapocalypse event. The VIX futures market, technically, the XIV should not have terminated that day. I mean, it wasn't down that badly. It was probably, if it was just a fully functional index, probably 35%, something like that. Something like the short vol index wasn't nearly as decimated because, of course, you know, it's new, it's a backtest, but also it's a different methodology. So technically, you're right that a lot of buying could legitimately cause a liquidity crunch in the VIX futures. That could happen. But A, they have fixed that. So right now, all of those underlying indexes have been tweaked a little bit to expand the trading windows, to use a trade at settlement market as well to try to mitigate some of that volume. There's a lot of things that they've done. They've increased the bid spreads there, so everything is kind of more smooth. Volapocalypse, you know, knock wood, shouldn't happen again. So supply and demand shouldn't be an issue going forward. Plus, the volatility ETP space is like, what, a fifth of what it was at its peak? So the VIX futures are plenty liquid enough today versus 2018 when it was, you know, the volatility ETFs were basically dwarfing the VIX futures volume. That's not the case right now. So under normal circumstances, even a billion, what would happen essentially, you might see a little short-term blip there where something's going on if literally somebody happened to get $1 billion through the VXX, which would be staggering, like it wouldn't happen. But then you've got the authorized participants that are actually managing it behind the scenes that can create and redeem shares to make sure that it's tracking its underlying indicative value. So technically speaking, as long as it's a reasonable volume, you're not even going to see that, right? If you look at the indicative compared to the actual, I can actually even show it to you if you'd like. You will see little short-term aberrations, and mostly these are, let's say UVXY, UVXY.IV. Why didn't that work? VXX VXX. Is my brain just frozen today? Is that not the, okay. I don't know why UVXY didn't work, but essentially what you're looking at is something like this, where this is basically the underlying ETF and where it is supposed to be tracking, which is the intraday indicative value. You can do just an ETF.IV and you can compare the two of them. So yes, you're going to see some very short-term fluctuations. These are just print errors, basically. This is not actually happening live. But you can see that it's basically tracking an underlying indicative value. That's what's happening, is that the volume that's coming in is immediately being absorbed by this process of redeeming and creating shares to make sure that these two things are tracking each other. And it works very well. They get paid very well. They do their job very well. And that's essentially what's happening. So it's technically true. You could have some type of liquidity crisis where it just is overwhelming. And then all the times that I've said supply and demand doesn't matter, that would look a little silly in hindsight. But That's just an aberration that you really don't have to be concerned about. The volatility ETFs function exactly as they are meant to function. Now, that doesn't mean always. Remember that Barclays forgot to actually make that filing, so it decoupled from its intraday indicative value. But those are events that we can see ahead of time, right? It's announced, everybody can see it, you can track it. It's not the volume that's doing that. It's an actually internal error at Barclays. So just to head off that question, oh, well, what about that time? There were a couple of times when they mismanaged the ETFs, no doubt. But yeah, overall, there you go. Camera's focused on the background. We got it back. Sony's supposed to have the best autofocus, so that's why I got this. Makes you look sick though, look like I have jaundice or something. Skin tone's terrible. I should get a Canon camera, but Sony's just by far the most reliable. Will you visit Spain? I know my wife wants to go to Spain. I know my mom has been and would go back. So yeah, probably within a couple years we'll go to Spain for sure. Italy, Spain, and France. We're kind of torn between those three. So we're doing France this time around. We'll probably do a month in Italy quite soon. My wife just passed her level 3 sommelier class, so she's kind of super pumped to go test all the wines. Bruges, it's like a fairy tale town. We'll see. I mean, I love that movie and the whole, like, sort of the backdrop. I'm old, so there's a movie called In Bruges, right? Colin Farrell, and who's that other? He's a really good actor. Who's that other actor? I don't know his name, but he's awesome. He was in Braveheart. I don't know. Older guy, red hair. Awesome movie. Go watch In Bruges just for the nostalgia. But yeah, the backdrop of In Bruges was the fact that it was such a cool little town. So my mom and I are both huge fans of that movie, so we're kind of wondering how close it'll be. We have to go to that clock tower, see what's going on. Check your eyes with an optometrist. They're focused on shoes. Yeah, I know. They like my shoes more than me. Don't know why. This is my stupid backdrop. I get people ripping on my backdrop, but as you know, I'm kind of a minimalist. I have nothing. Everything you see in this picture, that's my house. This is where I live. Those are my belongings. You can see them all. What else do I have? I have a rice cooker. I've got a bed just sitting in the middle of a room. Yeah, everything I own is almost in this shot right now. Oh, you can't see my golf clubs. They're over there. What is the point of having a spreadsheet? All that data is available in TradingView and is constantly updated. VX30 is easily calculated. Okay, so question, how did you calculate your VX30 without the data? That's why you need a spreadsheet. But also, let me be a little bit less cheeky about it. What if you wanted to actually design a strategy? So let's use this garbage, M1, M2 VIX futures, right? So let's say, just for the sake of argument, you wanted to test a strategy if this is greater than 0%, then short vol, otherwise cash, right? Let's say you wanted to do something like that. You wanted to just check how much what a strategy would be if you were only short vol anytime that the VIX futures are actually greater than 0. Well, now all I would need is I would just go here. If that equals short vol, and then this right here, this would be the daily percent change of the VXX, otherwise 0. So let's actually call it something, just so you can see VXX change. So it would look something like this, right? And let me move that out of the way. This is how you do quant strategies. Like, this is super basic, obviously, but now you've got the VXX data, right? So let's just put that here. You've got the VXX daily percent change, right? We've got that on this column. Now, all of a sudden, with just what I did now, I can tell you exactly the rate of return of shorting volatility just when the VIX futures are in contango, right? Now, can TradingView do that in 17 seconds or whatever it was in a spreadsheet? No, probably not, right? That's why you need the data. And then you say that VX30 can be calculated. Calculated based on what? It's actually not a simple calculation. TradingView doesn't, I'm sure TradingView doesn't do that unless you programmed it to do that. It certainly is not a default setting. And then let me ask you, what was the VX30 value on July 7th, 2008, right? Does TradingView tell you that? No. So this is why spreadsheets has to be the heart of all of your trading strategy building. Doesn't mean it's the only tool you have. There are platforms out there, there are apps out there that'll help you with back testing, but having the spreadsheet is extremely valuable to have this data. And like I said, I don't know what you're looking at in TradingView, but it certainly doesn't have historical VIX futures data, and it definitely doesn't have VX30. I can promise you that. So I commend you for doing that and programming it yourself and having that data. Hopefully you transferred and downloaded it over so you have it back to 2004. But if you don't, now you have this spreadsheet. I could do that for you in 20 seconds, and you could have all of that data going back. And then that could be the basis for an introductory volatility strategy. Or maybe you're saying, look, I only want to hold Bitcoin when the VIX futures are greater than 5% contango. Let's see what that looks like. That'll get you going, right? It's the same thing that I always talk about, that why do I do old school back testing? Why don't I seek out all these really cool platforms that can do all the AI back testing for me? It's because getting the answer isn't the point. That's not what strategy building is about. Getting the answer, just inputting what happens here. Let's sell iron condors with 10 delta both sides, 45 days to expiration. We're going to close at 7 days. Go, right? An app out there, a program out there will tell me the answer. It'll show me what the compound annual growth rate was, how many winners, how many losers. That's not the point. The answer isn't the point. The point is the process along the way and how many side tangents you're going to think about while you're manually doing this data. And it might take a few minutes extra. Like I showed, some of these things are extremely quick. You can go a long way. Give yourself a couple hours. You could expand on that spreadsheet a lot. But it's really not about getting the answers to your questions. It's about where that process takes you, where you can watch all the data develop in front of your eyes and you're not missing things. If you just hit a button and say go and it spits out an answer, that strategy, 13% CAGR, now what are you going to do? Well, now you're going to be in that over-optimizing, curve-fitting phase where you're going to go, oh, well, what about 11 delta? What about 12 delta? What about 43 days? What about selling at 9? And you're going to hit that button, refresh, let's do 12 days, let's do 10 days. You're going to keep hitting that button until you've got the best number. And then you're going to say, that's the best strategy, right? This is what curve fitting is. This is the trap that people fall into where they actually think the end answer is the goal. It's not. I could go through all of my strategies, all 5 of them, and I promise you there is actually an optimized number. Right? I could even do, and I've done it before, you can use Microsoft Excel and you can do an optimizer, and I can actually tell you which exact range on the volatility barometer going back in history would have turned out to be the exact optimal number. And I promise you, it's not going to be 63% on the nose. It's just not. It's going to be 61.87 or 64.31, whatever that number is, and it's going to change every day with new data. I could get that, but that's not the point. Just because the historical data going backwards said that that was the best number doesn't mean that it checks all the boxes of me building a diversified portfolio and knowing all the reasons why I'm doing everything, watching everything develop in front of my eyes and knowing that, okay, I'm not actually looking to see whether 12.5 is better than 13.1. That's not the point. The point is the process along the way. Why did I enter and exit these trades? What's the risk management? What's the proper position sizing? How does the correlations fit into the other portfolios? That's the important stuff. And in my opinion, it can only be done correctly in Excel or whatever spreadsheet you use. It has to be done that way. Long form, old school. I would be very wary about curve fitting and just, mining for the best thresholds. That's a recipe for disaster. This is why, 99% of amazing looking back tests, they fail in live trading. This is why, because it's not the answer you're looking for. It's the process that you focus on. So spreadsheets it just takes you right into the process. Give it a shot. But I would be interested to see what you have done to your trading view that would make that data obsolete. That's interesting because it's definitely not there. So you've probably done some programming of some kind. Insights about drawdown. Yeah, was that the same question? Yes. Yeah, just go with the formula there. It's as simple as it gets. Okay. Why going on leverage stocks instead of 2 times, 0 times on the regular asset? I mean, on the carry of the beta slippage. Yeah, you could do that. You could do, I could show you the numbers. I could show you QQQ 2 times versus the other way, just using the QLD. You could use SVXY. You could use 2 times that versus 1 times the SVIX. There's always ways to do that. But no, I just like to keep it simple. Just like to just use the leveraged ETF. For us, you got to remember that beta slippage doesn't always hurt, right? The time that you're holding the asset is actually what matters. And we're only holding the aggressive assets during their best periods. So I think you'd be surprised that beta slippage is, if it's a long-term buy and hold, if that's what you're concerned about, then yes, you have a point. But actually, it's not always a negative. When you look at them in comparison, it's the same. It's roughly the same. Value of the spreadsheet is if you want to do your own analysis, aggregate analysis, quantile calculations, statistical analysis, complex correlation studies between assets. Love it. Agree 100%. Yeah, if it's not useful to you, that's the thing about the volatility or the VTS community is, I don't know. I'm just trying to offer as much value as I can. And I try to make as much of it free as I can as well. It blows my mind to this day, but I still get a few people complain that I run, a subscription service. It's just, if you can show me somebody who has done hundreds of public videos educating on this stuff totally for free, live streams, answering everybody's question, where else can you go? 90% of my work is free. People will criticize anything, right? You could literally hand them a stack of cash and they'll criticize how you handed it to them. Oh, you put that 10 grand in my hand too aggressively. Why did you do that? You gave me a paper cut when you handed me the $10,000. Like, people will complain about anything, but I just try to make sure that I have as much free value as I possibly can. And this spreadsheet, while perhaps not useful for even half the community, to be honest, a lot of people don't even care. They just take my trade signals. They don't even want to calculate stuff. They're not interested in building their own strategy. They just trust mine. And not for nothing, it's going to be very difficult for you to improve on what I've done. So perhaps you should at least do your own and mine, do a competition, mine versus yours, for a couple years. You might be surprised. But yeah, this isn't for everybody. This is just for a select group of people who are really geeky into the quant stuff, and introductory spreadsheet to get you off to the races. I'm not claiming that this stuff is, world-changing or anything. All right. I should speed up. How long have we been going? Too long already. I'm looking at the VIX term structure. Is something happening in October? The election. It's just the election, elevated because of the election. It's been like that for months. That October future, just simply because, of course, the election is after that. So all of the trading action is going to be before. After the election, there's not going to be any uncertainty anymore because the election will have already happened. So that October future is going to be where all the trading action is. And you just get used to it. Now, as far as volatility ETFs, remember, they're using a VX30. They're using a rolling combination of a 30-day constant maturity VIX future. So it's not going to affect anything that we do, but it's just going to be that little kink. Every 4 years, there's an election kink. Sometimes it could be something else. Like, you might notice maybe if there was a really instrumental interest rate decision coming, like, say, back when they were first deciding when is the Fed finally going to raise rates, that first time, you might see VIX futures kinks around those dates. You might see obviously presidential elections. You might see debt ceiling stuff, whatever it is. But because an election is on the calendar and we've known forever that this is going to be just a wild, it's going to be crazy this election season. Especially now since Trump has the legal troubles as well. And that's just going to embolden him further and his followers. And don't get me started on that political blunder of, charging the guy for, yeah. Should I go on a side tangent? I don't know, but that seemed like a very poorly calculated decision on whoever's brilliant idea it was to try to take down a cult-like figure with legal action. I'm sorry, that is not going to work at all. It's going to have the opposite effect. But anyway, political rant over. What were we talking about? Something. October future election. Don't worry about it. Unless you want to jump in the ring and start trading it, then go for it. I don't typically do that. I don't do a whole lot of, or hardly any discretionary trading in the VIX futures. I like the ETFs. I don't really trade the futures myself. I just trust the packaging, and I am the quant trader that uses the packaged ETF to my advantage. But go for it. For anyone that hasn't seen it yet, you must watch my Sharpe ratio video. Totally turned my investing around. I super appreciate the compliment, the recommendation, but that's an old school video, and it's a series of 5. So there's Sharpe ratio, Ulcer index, there's correlation, maximum drawdown. But that series, like I said, it's due for an update. So here is our course library. I will definitely at some point circle back and start building this course out because we can go far beyond just those 3 or 4 metrics. Yeah, but thank you. Appreciate that. What happened to the sword? Sword's in Taiwan. I have a couple belongings that I left behind. Yeah. My katana sword from Japan. Taste the beers in Bruges. We are looking forward to Belgium. I think we're going to get a pretty good trip because those are, I've never been, so I can't say for sure, but they sound like quite different areas. Like a cruise on Norway is going to be a totally different vacation than hanging out in Paris, right, for example. And so we're going to get a little bit of everything. It's going to be a pretty awesome trip. We tend to do these. I haven't been back to Canada. I had a whole extremely terrible experience with Canada and the pandemic and the forced vaccination, and didn't want it but was forced to take it so I could get out of the country because I wasn't a resident of Canada, and if I stayed any longer I would have owed them taxes and would have lost my residency in Panama at the time. It was a total nightmare, and I didn't support all those mandates or anything. I did live streams talking about it and ranting about it to my detriment because at the time it was unpopular. Like I was ranting against the government policies pretty early on, and at that time it was very unpopular, and I got a lot of hate mail. But now, 4 years later, everybody's acting like it was just common knowledge. Well, no, I was talking about that stuff. But yeah, I haven't been back in Canada in ages. So what we have been doing is just getting my mom to come on extended vacations with us. So we did super long trip in Switzerland last year, and we're going to do just a pretty exciting trip this time around. So, I'm not a programmer. You probably know that. You hang out with us on the live streams a lot. You're probably 100 times better at this stuff than I am. I've never even heard of that. But that's good for you, for sure, that you can do all that. I would still say you'd want to export it to a file so you could actually start working with the data instead of just looking at it, right? Yeah, use them in tandem. I'm certainly not saying you have to do one or the other, but I think you'd be surprised. I guess I could open up a spreadsheet of mine, but then I would be showing you my actual strategy. I think you'd be surprised how much you can do in Excel still and how useful that is. But to each their own. If you prefer to just see the data in front of you, then that's just great. Okay, Pine script is also really tedious sometimes compared to a spreadsheet, and a spreadsheet allows you to quickly add columns for whatever. Yeah, see, like I said, with here, I don't know how long that took, but that was just a simple test. Or you could just do like, what is the, percent rank of, I don't know, of this value compared to all past values, right? What is that percent rank? Go down. Let me move that again. I'm kind of ruining this spreadsheet. But that you've got all the percent ranks, so then you can basically just build a strategy that says, well, if X number, whatever it is, if it's a percent rank over 67, and then you've got 5 different metrics, you've got, the if just choose 2, maybe you could do the VIX to the VIX 3M ratio, and then you could do the, I don't know, like I said, VX30 to VIX roll yield, those 2 metrics. And now you're starting to get a little bit more complex, right? You're starting to actually have something. You do, if this and that, then hold the VXX. If not, hold cash. Or if not, go into bonds. Or if not, go into gold. And then all you have to do is just have gold, real estate, utilities, emerging markets, have all of that there. And you can compare all of them side by side. You can say, look, okay, I've got a strategy. I understand that I'm supposed to be in gold when the X, Y, and Z ratios are above this number. For this 30% of the time, I'm going to be in gold. But I wonder what it would look like if I substituted bonds instead. Or I wonder what it would look like if I substitute emerging markets. Just one coffee, you can get the answer to that, and it's right in front of you, right? So I don't know. To each their own. JD, the hair would be worth the money. Okay, what is going on? I like the crosstalk. People are helping me out a lot. Also, how do you have such a great head of hair? I'm always worried about my hair. I'm definitely worried. I actually joked to my wife that, I'm 49 now. How long is it going to be before I have to make a trip to, Turkey? Like the world leader in hair transplant surgery. It's funny because, hair is not important. Most men are going to lose their hair. So I always said because my grandpa lost his hair, I think they said that it skips the generations. My dad had a decent head of hair, but it was thinning a bit. But I always said, if I just make it to 30, I'll be fine. And then I made it to 30. And then if I could still have my hair at 40, okay, then by then I'll be married, it'll be fine, nobody cares. And then I crossed 40, and now I'm like 50. So 50's, next year. And now I'm thinking, wow, if I lose my hair before 60, I'm certainly going to have to make a trip to Turkey and get some transplant surgery or something. But appreciate the compliment there. Yeah. I don't know. I am married, so I guess it doesn't matter. But boy, I'd like to keep it if possible. JD, the hair would be worth a monthly subscription if you could sell that. Yeah, maybe I have less than it looks on camera. I don't know. I think I'm doing fine. Thank you. Appreciate it. Appease my vanity. I agree about exporting it. I have all the raw data and have generated histograms, quantiles, etc., and the calculations, and now I'm taking the additional step to export the data. Yeah, awesome. I like having it in front of me. I have so many ideas that, like I said, I really don't want people to miss the good stuff with strategy building. Get an extra sheet, like a Google document or something next to you. Open the spreadsheet that I gave you and just let your imagination go. And every time you have an idea, make a note of it in the Google document. Oh, I wonder what would happen if I tested this, and write it down. And then do that test. And I promise you, before you finish that test, you will have written 3 more tests to go check after that. And then you're going to just pick one and go do that test. And by the time you finish that one, it might take you a couple of coffees. By the end you finish that one, you're going to have 5 more things added to your sheet. And your Google document of here's the things I want to test is going to be an absolute nightmare. And this is why when people ask me, how is it that you work for 10 hours a day for 18 years on this stuff? Well, this is how. The rabbit hole is insane. Once you get going, I hope people have this experience because I think it's a positive experience. I love it. Once I get going, the world just, my wife will tell you, it's, I don't hear much of what's going on around me when I'm in my spreadsheets. It's, you basically have to walk by and slap me in the head to talk to me. So don't get in trouble with your wife. But yeah, I love crunching numbers and building strategy, even though it's proven very, very difficult to improve on what I've already got. I still try every day. So, all right. I do quant trading in Quant Connect. I mean, you're way beyond my level. We're not even going to be able to speak the same language, basically. You're so far beyond where I am. Like I said, I just do what works. I just make it work for me. Don't have any, didn't do any courses or anything like that. Nothing. Just think of something. YouTube has been a savior for me. Just, hey, how do you do such and such in Excel? Trust me, there's a little tutorial for everything. I've watched a million of them. Working on building out a data warehouse for more robust use. Look at you guys. Yeah, here I am giving you, basic data, and you guys are building data warehouses. And okay, can you share it with me, please? So, all right, we'll call it there. This is the last official live stream for the next 5 weeks. But like I said, as long as I've got decent internet, and we did all the upgrades on the boat, we got the all-inclusive package that includes what they say is their fastest Wi-Fi. Hopefully, I will take my camera. Hopefully, there will be live streams. 5 weeks without would be rough. But yeah, thank you, everybody. And shoot me an email if you know where I should be going on our trip. You can definitely enhance it. We don't know much about Europe, but the wife does like, spoiler alert, she likes expensive restaurants. She likes cool rooftop bars, Instagram paradises, things like that. So give us some recommendations. We would really appreciate it. All right. Good night, everyone.